Please stay tuned for important disclosure information at the conclusion of this episode.
Hi, and welcome to The Long View. I'm Jeff Patak, Chief Ratings Officer for Morningstar Research Services.
And I'm Christine Benz, Director of Personal Finance for Morningstar.
Our guest today is David Giroux. David is Chief Investment Officer of U.S. Equity and Multi-Asset at Rowe Price and co-chair of the Equity Research Advisory Committee. He also is the longtime lead manager of the Rowe Price Capital Appreciation Fund, a strategy that invests in a mix of stocks and bonds. Since taking that fund's helm in June 2006, David has racked up an impressive track record, handily beating the fund's benchmark and peers. In recognition of those achievements, Morningstar Analysts named David Fund Manager of the Year twice, in 2012 and 2017. David began his career at T. Rowe in 1998 after graduating from Hillsdale College, from which he received his bachelor's degree in finance and political economy. David, welcome to The Long View.
Thank you for having me. It's really a pleasure to do this with you guys today.
Well, thank you. To start on a personal note, can you talk about your journey to investment management? You joined T. Rowe after graduating from a liberal arts school in Michigan. That's different than the path money managers tend to take, which often winds through business school or the sell side. So how did you manage to land at T. Rowe? And as you reflect on it, has the atypical journey you followed helped you professionally?
It's a good question. You know, when I went to college in 1994, I really thought I wanted to do something in either history or politics, and that was really kind of the college I chose. Really kind of midway through that college experience, I kind of just discovered investing, and it was something that, it was this amazing opportunity. I was like, well, this is really what I want to do with the rest of my life. And I ended up reading, I think in college, like 35 different investment books about Ben Graham and Warren Buffett, and just really consumed all I possibly could around investing. And I had two really amazing professors, a gentleman by the name of Howard Morris and Jack Parham, who were really instrumental also in my kind of journey, if you will, into finance, and just really enjoyed finance. And so right after that process, I decided I really wanted to be an investor. I reached out to T. Rowe, and at the time they had an opportunity, they were looking for an associate analyst, and the rest is history, if you will. I'm not sure of how that has changed the kind of investor that I am. I will say a lot of those books that I read, were very value focused, a little bit contrarian, a little bit kind of GARPy. And if you think about the kind of investor we are today, or the investor that I am today, and the way I manage depreciation, we run that kind of contrarian, value, kind of GARPy kind of strategy. It's kind of the core of what we do.
Can you talk about the importance of generalism across asset classes, industries, and so forth to your success as an analyst and later as a portfolio manager? And what has experience taught you as the right mix of specialization and generalism when it comes to investment management?
Christine, it's a really good question. It's something I think about a lot. I think it's actually something I've changed pretty dramatically from when I first became a portfolio manager to where I am today. I hold a lot of different kind of titles at T. Rowe, but my real job is being an analyst. I'm a big believer in what I call the micro part of investing, where you get to know a company really well, deep insights, model the company out for 5 years, take a longer term horizon. I think if you do that kind of analysis, you can find those situations, those dozens of companies where the odds of outperforming are so substantial over a 5-year period of time, where you have 75% kind of hit rates over a 5-year kind of horizon. And so when we think about the general aspect of investing, there's different ways you can think about that. So we already talked a little bit about the micro. When I'm a general, we do want to identify kind of ponds, if you will, where the odds of success are really, really high. You want to go fishing in a pond with a lot of fish, not in a pond with not a lot of fish. And so, we've identified a lot of different kind of areas of the market, names, categorizations, where we want to focus our time and attention in those areas and then do the deep dive, generate deep insights to identify kind of those stocks that are the best risk reward in the marketplace. I think that the generalist kind of portfolio manager who's not an expert on those companies, who says, rates are going to go up, so I need to go buy these companies. And, that may work, but I think that's far less likely to generate real alpha for clients on a longer term basis.
We're going to talk more about investment process and decision making later in the conversation. But before we got to that, given we're in the thick of outlook season with many firms publishing their economic and market forecasts for 2020 and beyond, we thought it made sense to talk about that. Last month, T. Rowe published its outlook, which you helped co-author. So let's start with this. Stocks and bonds look expensive by many measures. Given this, where do you and your colleagues at T. Rowe think we can expect to earn a good return, and why?
Well, I think the comment is correct. When we look at investment-grade bonds, we look at treasuries, it's a very negatively skewed risk-adjusted return, right? You have rates stay low, you get a low return, and if rates go up, you lose money, and there's not a lot of room if rates go down. The thing is going on with the equity market in general, right? Even if we got to 2022, which would be a more normalized earnings year, fully pricing in a recovery, you're already at 20 times that number, even before you account for tax increases, right? So the traditional S&P 500 or small caps or treasuries or IG, they're all expensive. They don't have a really great risk-adjusted return from here. But again, we can invest at T. Rowe independent of that index, right? There are parts of the market that are exceedingly expensive. We can talk about a Tesla or an Apple or SaaS software companies or some of the more recent IPOs. But there's also parts of the market today that are very, very attractive, that are actually trading at very low valuations, usually because they don't correspond with the macro sentiment of the market, right? Whether it be a GARP stock, some of these GARP stocks that we really love in our portfolio that generate really good risk-adjusted performance over a long period of time look really cheap. Utilities are kind of at a 40-year low versus investment-grade yields. And even within the cyclical bucket, there are parts of the market, like financials, that look actually pretty decent. Not as decent as they looked, 2 or 3 months ago, but still look very good relative to other parts of the market. So the secret is not, we don't invest in markets. I don't invest in indexes, right? We invest where we find real good fundamental value at an individual company or an individual bond level. And that's what we've done historically. That's what we'll continue to do going forward.
You've previously written about the linkage between economic forecasting and investing. People often struggle to predict things like GDP, inflation, and interest rates. But even when they get those things right, they may make the wrong investing call. And we saw a lot of that coming out of the global financial crisis, where macro forecasters were correct that growth would be slow, but wrong in favoring bonds over stocks. So is there a way to get both calls right and profit as an investor?
Christine, I think it's a really good question, and it really goes to kind of market inefficiency. We look at everything through a kind of a market inefficiency lens, and I think your point is a really good point. The market at times will take a view on a macro outcome. We're going into recession, rates are going to go up, rates are going to go down. What you often find happens in these situations is that macro environment, that macro view, it becomes the only outcome, right? It's 100 to 0. In 2008 in Q1, everybody thought the 10-year was going to go to 4 and went to 2, right? Everybody thought, going into 18, we'd have a great stock market. End of 18, the market was basically pricing in a 25% decline, basically pricing in a recession, if you will. So that macroeconomic consensus is often wrong. And really what we try to do is when you get to the extreme where the market says this is the only outcome and it's already priced in, we kind of tend to take the other side of that argument. Again, in Q2 of 2018, when everybody hated utilities, we were buying utilities because the risk-adjusted return looked so good. They were already at the lowest valuation in a decade. If rates went higher, you didn't have a lot of downside. If rates went lower, you made a lot of money. In the same way, in Q4 of 18, the market said, we're going into a recession. We're going to price in a 25% decline in earnings. We went overweight equities, took the other side of that, ended up being right. So it's almost like when the market gets to these extreme views, you almost want to take the other side of it. Even today, we find ourselves in an environment where the market is, we're going to have big earnings growth this year. That may play out. That may be exactly, but the market forgets about valuation. All those cyclicals that the market wants to buy today, they're already up. They're trading at very high valuations, not only at 21 earnings, but 22 earnings. So really what you want to be doing is kind of usually from a macro perspective, doing the opposite what the market wants, because that's where the best risk-adjusted returns are, historically speaking.
Many retirees are wrestling with the question of how to meet their goals when stock and bonds both look rich, safe sources of income are kind of hard to come by, and they can't afford a big drawdown. So, as an allocator of capital and someone involved in forging T. Rowe's market outlook, how would you advise a retiree in that situation?
Well, the first thing I would do, and this is maybe a little bit of a plug, I would advise them to buy the cap appreciation strategy, because that's exactly what we're trying to do. We're trying to give you the best return possible with the lowest risk and the lowest drawdown risk. That's what we're trying to do for our clients on a long-term basis. But maybe more specifically to your question, stocks are expensive, bonds are expensive, where do you see value? And I would say two areas we kind of see value today would be like leveraged loans. Leveraged loans are floating rate instruments. They have yields that are twice that of investment grade bonds, 3.5 times the yield of treasury bonds. You don't take any kind of interest rate risk because they're floating in nature, as we talked about. And they're exposed. They don't have a lot of energy in them. There's not a lot of energy leveraged loans. There's not a lot of retail leveraged loans. So it's actually a pretty good index of companies, if you will. So again, at 3.8, 3.9% kind of yield, that sounds great. But relative to the alternatives, I think leveraged loans makes a lot of sense. And T. Rowe has an amazing leveraged loan strategy run by Paul Massaro here. I would also say, and again, I made a comment earlier, is if people are looking for income, not only income, but appreciation over a long period of time, is utilities today, where you can get 3.5%, 3.4% kind of dividend yield, where the underlying earnings for these companies are growing at 6, maybe 7%, and the valuations are kind of 40-year lows versus investment grade bonds. Those are two areas where someone is looking for either income or looking for income and appreciation and not looking for a lot of downside risk can probably do quite well.
T. Rowe Price recently announced that it was, in essence, subdividing itself and forming a new entity, which you'll be a part of. Can you talk about the impetus for this change and what goals it will advance?
Sure. So when I joined T. Rowe Price back in 1998, and maybe my memory is a little bit off on this, but we had maybe a little bit less than $100 billion in assets at the time. Today, again, as of our last filing, I think we had $1.3 trillion in assets. During that period of time, my 22-year career at T. Rowe, a lot of our funds have outperformed. And that's kind of driven you think about it, it's the equivalent of having incremental flows. And even though we are a active manager as opposed to a passive manager, we continue to have positive flows. So, our market share has gotten a lot larger over time since when I joined here. Materially larger over time. The challenge has been that the number of public companies over that 22-year period of my career has been shrinking almost every year. So takeouts, are substantially greater in most years than new IPOs. So we have a diminished universe of companies, and I would actually argue maybe even a little bit lower quality group of companies, because usually the lower quality kind of companies are still staying around, if you will. And so we've been able to overcome that challenge of being bigger or taking more market share over my career because we continue to invest in fundamental research. We continue to invest in fundamental research in the dot-com bubble, in the great financial crisis, and even now when a lot of our sell side and our buy side competitors are really kind of moving away in some cases from fundamental research, we're continuing to aggressively hire. So we've been able to overcome those challenges. But long term, a portfolio manager needs to be able to buy the companies they want and in the quantity they want, obviously consistent with their risk objectives. And I think there was a real risk, not tomorrow, not next year, but there was a real risk 5 years down the road, 10 years down the road, that if we didn't make this transition now, maybe we wouldn't be able to overcome these challenges anymore. And I would also say I think it's an important aspect. Think about when I was an analyst or an associate analyst back in the late 90s, early 2000s. I only probably interacted with 10 portfolio managers. There's a lot less complexity in my job in terms of selling my ideas to the platform. Today, an analyst might have to sell those ideas to 20, 25 portfolio managers. And that creates more complexity. It means that there's a little bit less one-on-one interaction. I think one of the big benefits of TRPM, splitting off from TRPA, T-Rowe existing, if you will, is going to be the reduction in complexity, having fewer analysts interacting with fewer portfolio managers, really getting back to kind of the way Rowe Price was back when I joined the organization. Again, more one-on-one, less email. I'm really looking forward to that.
How have you worked through the process of determining who and what you want to bring with you to the new entity?
Well, the who we're bringing to the new entity, I'd say there's a couple things, maybe cast specific. Obviously, my whole team's coming, and Farah Shugi, who's a quantitative analyst, a really dear friend, who has been a really instrumental person in kind of helping shape how CAS should invest from an asset class perspective, a factor perspective. He's coming to the new entity as well. And I think what was really important is when we think about, dividing the research platform, obviously there's some analysts who are more small and mid cap. Obviously the Turpin platform, most of the portfolios there will be more SMID focused. So if you're a SMID analyst, it's more likely you're going to be going to the Turpin platform. Again, I think, Jeff, you and Christine I think you know the strategy that I run. As being an analyst, we're a little bit less dependent upon the analyst pool relative to the average portfolio manager because we're doing a lot of our own work in addition to working with the analysts. And so, we're not investing in every sector in the S&P 500. We're a little more concentrated, not only in our names, but in the sectors we participate in. So it's really important that the areas that I care a lot about, not only in the short term, but in the long term, we have good resources there. And the answer is we really do. So a lot of the people who I interact with on a day-to-day basis, from a sector basis, from an analyst perspective, a lot of those people are coming with us. In addition, we also got a much larger team, as we've recently added Brian Solomon and Vivek Rajesh Warren to our team as well. So, I think in many respects, we're getting all the benefits of improved capacity, easier to trade, but you're also not really losing all the resources that you really care most about.
You're T. Rowe's Chief Investment Officer for U.S. Equity and Multi-Asset Strategies. Can you talk about what you view as the most essential aspects of that job and whether you'll approach it any differently now that you're under the umbrella of the new entity?
Well, to answer the second question first, there will be nothing different about what we do. So, again, when I think about the role of a CIO, I'm also the head of investment strategy at T. Rowe and will be at the new entity as well. There is value for clients to hear me talk about stocks versus bonds or, economics or politics. But honestly, Christine, that's not where I add the most value. I actually view that as a little bit of a low value to the organization endeavor. Where I really think we can add value, where I really try to add value to the organization, is if there's something big going on, whether it be tax reform, whether it be coronavirus, whether it be a certain area really out of favor. What I tend to do is I do a deep dive into something and try to figure out what the market doesn't understand, what are the market inefficiencies we can exploit, and then try to share those insights across the platform. So obviously in 2017, we helped get the platform comfortable with the idea that tax reform was going to happen. These are the big beneficiaries. Whether it be from an analyst or for our portfolio managers, we got on the right side of that trade. In February and March of this year, I realized that the only thing that was really important at that time was really the pandemic, right? What did COVID-19 mean? There was a tremendous amount of fear, rightful fear. We had people going on the news saying 2 million people are going to die this year, 80% of people would get COVID, vaccine's not going to come until the end of 22. And then, we take 23 to get it distributed. So really, I stopped everything and did 25 different calls with doctors on the front line, some doctors right outside of Italy, right outside of the Lombardy region. I talked to virologists. I talked to, R&D people who used to work in pharma, talked to professors of medicine, if you will, about this. And we really came up, as a result of those 25 calls, with a really differentiated view that was very, very different from a consensus. We had a view that, based on those calls with these experts, that a vaccine could be done in less than 12 months. Not only that we would see a vaccine, but that it was actually hard to produce, because relative to flu, this was actually an easier putt, if you will, because this It does mutate, but mutates less than flu. So, we came to the view really early, much earlier than the market, that this would be something that we'd be able to live with it, that it would have tremendous collateral damage, but it wouldn't be a situation where we wouldn't be back to normal till 23 or 24. And that helped not only me, but I think other people on the platform had that insight, maybe get a little more aggressive with their equity exposure or even the kind of equity they had in March. Or during that period of time, we were also kind of looking at industrials and cyclicals and semis and saying, how long did it take in the great financial crisis to get back to kind of peak earnings? And if this cycle was like the great financial crisis, what were the internal rate of returns for buying stock in March to that kind of 1 or 2 year view? And we highlighted that to the platform. That's like, hey, this is a template. This is what happened that cycle. If this cycle plays out just like that, you can make 30, 40% returns in the next 2 years buying these names. So it's going deep, providing a little bit of history. That's really what I think the true value add of at least how I approach the CIO role, head of investment strategy. That is deep insights where you have something that the market doesn't understand, it's exploitable, and you can share with the whole platform.
We're going to talk about portfolio construction in a moment, but before we did that, I wanted to follow up on an earlier answer you gave when we were asking what a retirement income investor is to do. And you offered a few useful ideas like leveraged loans and utilities. You also suggested looking at the Rowe Price capital appreciation strategy itself, but we would note it's closed. So given that, is there another strategy on Rowe Price's platform you'd highlight as an alternative to Rowe Price capital appreciation?
Well, I'd say a couple things. We are closed to new investors, but obviously existing strategies and existing firms that already have exposure to CAF, you can still get exposure to CAF. We still have positive flows. So, if you go through certain platforms that you already have exposure to, their existing clients, it is possible to get exposure to CAF. But having said that, if you don't have access to one of those platforms or one of those partners that T. Rowe has, there are other strategies I would think that would make sense. Again, I already mentioned a leveraged loan strategy would make sense. I would honestly say that, buying a utility ETF would make a lot of sense these days. Other strategies at T. Rowe, we have a dividend growth strategy that, again, maybe when combined with a leveraged loan strategy, tends to have a little lower risk profile than that of the overall market. Has a very good manager, has a very good track record. So maybe dividend growth, maybe utility ETF, maybe the leveraged loan strategy at T. Rowe would all make sense if you can't get access to CAF.
Can you talk about how you arrived at the somewhat idiosyncratic approach to portfolio construction that you followed? Most balanced portfolios are kind of a staid mix of U.S. blue chip stocks and high quality bonds, but yours isn't that. So let's talk about how you settled on the style that you employ at the fund.
Christine, everything we do, we have three objectives for the strategy. I think we talked about this, we want to outperform the market on a risk-adjusted basis every year. If you give us money today, we want to not lose money on a 3-year basis. And over a full market cycle, we want to be able to generate equity-like returns with much less risk. So when you think about portfolio construction in that construct, what you really need to solve for is where are the best risk-adjusted returns in the marketplace? What are the sectors? What are the kind of names? What are the factor exposures? What are the asset classes that deliver the best risk-adjusted returns? I'm really trying to get as much possible return as I possibly can, but with minimizing downside risk. So a portfolio of just blue chip, large S&P 500 companies, that is not the optimal way to achieve that objective, if you will. So, everything we do is kind of trying to find those names that have those really attractive characteristics. And for example, again, if you think about the heart of what the capital appreciation strategy is we're always overweight kind of GARPy stocks. GARPy stocks that are not growth or value, somewhere in the middle, is the inefficiency in the marketplace that allows these great companies that kind of grow earnings or cash flows faster than the market, lower cyclicality, lower downside risk. They should trade for higher valuations than they do. So that is an area where you typically can outperform the market in a GARP portfolio over time, but you have a lot less downside risk. I would also say when we think about things like double Bs or leveraged loans or writing covered calls, those all have very attractive risk-adjusted returns over time. So again, you're trying to find those areas that have the highest return spread versus the risk you take. That's really how we built the portfolio. It's not S&P 500 and a Barclays Ag. That's not the optimal way to achieve those three objectives.
So when you've had clients follow up on a question similar to the one Christine just asked, essentially asking you why these growth at a reasonable price stocks or double B rated bonds misprice, how have you answered that?
I mean, both of those are great examples of market inefficiencies. We really don't like to share our views on market inefficiency that much. We kind of hold that dear, if you will. So the question is like, I think what drives, in many respects, the multiple of companies is a little bit supply and demand. So the reason why this 13% of the S&P 500 that I call GARP trades where it does, and it should trade higher, is that a value manager will often look and say, well, these companies, they trade for 10 or 20% premium to the market. That's too expensive. So I can't invest in those stocks. Growth manager says, you know what? These companies, they're only grown organically like 4 or 5% organically. I want to own companies that are growing 10% organically. So in many cases, there's no natural buyer for these companies. So that depresses their valuation to a level where, again, you can, if you think about the market, the market typically in non-recession years kind of grows earnings at 6 to 7% kind of clip, gives you a 2% dividend yield. So for a small premium to that, what you'll be able to generate is find companies that are growing earnings at 10% plus, maybe getting a little bit more dividend yield, and have much less downside risk because there's this inefficiency. The two big market participants kind of shun these companies a little bit. And so what happens is over time, they just compound wealth. And in many cases, the market becomes a little smarter over time and says, oh, that company used to trade for 18 times earnings, but it's actually a really good company. Maybe you should trade for 20 or 21 times or 22 times. So you get the compounding of the earnings and the dividend, and usually like the multiple expands. Some of our largest investments, when we first bought Thermo, made it a 300 basis point position in the fund, it was trading at 12 or 13 times earnings. Today, again, earnings a little bit messed up for Thermo today because they're doing so well with testing, but Thermo's multiples basically doubled. Fiserv's multiples up 50%. So these companies have compounded wealth at a double-digit clip, then the multiple expanded. And the only other part of it, as we think about it, is like retail investors who, they're not likely to own Thermo. They're not likely to own Marsh Mac. They're not likely to own Fiserv. They're more likely to own Tesla or Apple. So again, all the forces of the market tend to ignore, for lack of a better term, these really amazing companies that have these really great risk-adjusted returns. They're compounding wealth at 50% higher rates in the market, or 40% higher rates in the market with much lower risk. They should trade for much higher valuation. Jeff, your question on the double Bs. So double Bs are probably the highest risk-adjusted return of any asset class that you can invest in. So I always say, well, why wouldn't a high-yield manager always be overweight double Bs? And the answer is double Bs tend to underperform the high-yield index 3 out of every 5 years. But the 2 years they tend to outperform a ton because the triple Cs and single Bs are down a lot and the double Bs do much better in that kind of down market environment. So over a full market cycle, double Bs kind of tend to do right along the high yield returns, but with much less risk. The reason why most managers are unwilling to be overweight double Bs is because they don't want to underperform 3 out of every 5 years. So that's another inefficiency we're trying to take advantage of in the marketplace. Again, I'm not going to go through all of these, but there are 16 market inefficiencies that we focus on. We talked about 3 of them already that we think are kind of exploitable, that are doing something a little bit different than everybody else, that allows us to generate the returns that we have over a long period of time.
Well, speaking of inefficiencies, I'm curious if convertible bonds are another of those areas. Convertible bonds have long played a role in your strategy. Do you find that they're still an underutilized, maybe misunderstood tool in the fund world? And if so, why is that?
Actually, when I took over the strategy in 2006, I think convertibles were about 20% of the portfolio at the time. And unfortunately, there were some accounting changes that went into effect maybe, 3 or 4 years after I took over the strategy. And it really just killed a lot of convertible issuance. So convertible bonds, outside of mandatory convertible bonds, are a much smaller part of our portfolio. I think today, we're like 1% convertible bonds. It's just, what convertible bonds are today are really a way for highly volatile companies to monetize that volatility at a very, very low cost of capital. So sometimes you'll see these companies issue a convertible bond. The stock has to go up 40% to get in the money. You're only earning 25 basis points of yield. Doesn't make a lot of sense. I really do wish those accounting rules had not changed. We saw a lot more investment grade kind of larger cap convertibles, because actually, to the point I raised earlier, convertibles historically have had a very good risk-adjusted return, but unfortunately, they're just a very small part of the market today. And really what convertible bonds have turned into is just this monetization of volatility for a lot of high volatile companies. So that's not really in our kind of wheelhouse, if you will.
I wanted to shift over to fixed income for a moment and ask, do you think differently about duration management as a tool when it comes to managing the bond sleeve, given that rates have continued to go lower and remain pinned down?
Well, again, I'm not convinced rates are going to be low forever. When we think about duration, again, I think that is a macro consensus that rates will stay low. I think if you ask most people, that is a very high odds. Is that true? We'll see. Again, the market thought in 2018 the rates were going from 3 to 4, and now everybody's convinced, the yields are going from 1 to 2, but not above 2. We'll see. What I would tell you about, rates today is that the risk reward on treasuries or IG is so poor. Again, it's a situation where if rates stay static, you make very, very low returns. If rates revert back to more normalized levels, you lose a lot of money. And if rates go down, you don't have a lot of room for rates to go down. So it's really hard to get a really great return. So it's a really negatively skewed risk-adjusted return, which is the exact opposite of where we were in 18 or even 13 when the 10-year was at 3%. Because at that point, even if rates rose 100 bips over 2 years, you made zero return. If rates stayed where they were, you made 3% return. And if rates went down, you made a big return, right? It was a very positively skewed risk-adjusted return. So as a result of that, we have a very short duration in our fixed income portfolio, probably the shortest duration we've had since I've been running the strategy. Our duration today is about 1.5 years, just because that skew is so negative on a lot of traditional fixed income. Just think about this today. An investor who bought a 10-year treasury on December 31st at 92 basis points and holds that for the rest of the year, assuming rates stay where they are today, they're going to have a negative return for the year, because the depreciation of the bond as yields have risen from 92 bips to 110 overwhelms that 92 basis points of yield they were getting at the time. So this is a time to be short duration in your fixed income portfolio. And if you're going to take duration risk in your equity sleeve, not in your fixed income sleeve. Duration risk in equities is really cheap, given how attractive utilities are priced today relative to investment grade or treasuries.
If you were starting from scratch and you had no clients breathing down your neck, no prospectus limitations, no career risk, and so forth, what would your portfolio look like? And how might it look different from your portfolio today?
Well, let me answer the question just a couple different ways. One, first of all, I would say I don't worry about career risk, not because I have a good track record, but I want to do what's best for my clients on the next 5 years. And that means trying to generate the most alpha I possibly can on a risk-adjusted basis. And if that means there's more risk in my career, so be it. And again, I would also say I have wonderful clients. I enjoy interacting with my clients. None of those things kind of change how we manage the portfolio. So what I would tell you is I manage the portfolio because I own a lot of it. It's my largest holding. It's my family's largest holding. It's my friend's largest holding. And I want to do the best job I possibly can for them. That's the only thing. And so I built a portfolio today, as in the past, that again tries to achieve the objectives that we're looking for. Really good risk-adjusted returns, being contrarian in certain areas that the market likes or doesn't like, having a short duration in the portfolio. If I were not employed at T. Rowe Price and I was trying to build a portfolio, it would look a lot like the portfolio we have today. Now, let me answer the question a little bit differently too. If we had to start over and someone said, you have to build that portfolio from the ground up, and you didn't have these objectives. How would you do it differently? What I would say is I've always been a big fan of Berkshire Hathaway. Always been a big fan of Berkshire Hathaway. Even going back to 1996, when I was reading all those Berkshire Hathaway letters that my professor Howard Morris had told me I should read. I really like that aspect of kind of almost be able to own public companies, be able to own private companies, to have kind of permanent capital, even a closed-end fund structure as opposed to an open-end structure, and invest on a much longer time horizon. I think that would, if we had to rebuild cash today, if someone was giving me an option, I think we would do it a little bit differently. But we can't do that. We kind of establish these objectives. Clients understand what they want from us. And the objectives that we have for the strategy are very, very difficult. And so it really requires a lot of alpha generation, requires a lot of the ability to go across asset classes, finding where the best value is. It requires a lot of work.
We're going to shift back to stock picking if we can. Our research has found that the stock sleeve of the Capital Appreciation Fund has done exceptionally well over time. You've been a really good stock picker. To what extent do you think that's been at least partly about knowing your own limitations? And what's an example where you think the portfolio has benefited from you simply staying away?
Well, again, I would say a couple things there. I would say if you look at I think over my career, our equity sleeve has outperformed the market by over 400 basis points per year. And I think really what that comes down to is an amazing platform at T. Rowe that really spits out really great ideas. So we have this great platform. And I think we complement that with the really good micro work. And then we also complement that with understanding what are I keep using this analogy, what are the lakes with the most fish in them, where the highest odds of generating alpha are, right? We've done a lot of work identifying those areas. So if you think about all those things are some of the ways, and again, I keep going back to this as well, where's the market inefficient? And if we understand those market inefficiencies that we're trying to exploit, we're really playing a very different game than everybody else in the marketplace. And I think that's what's allowed us to be able to generate the alpha we have over the period of time we have with the consistency we've had. Now, Jeff, to your question about areas where it's best just not to kind of ignore, if you will. One of the things I think we've done a lot of work on, I've been very public about, is kind of, it used to be 31% of the market, now it's about 25% of the market, are companies that are kind of secularly challenged, if you will. These are companies that are, that their business model is going under stress, whether it be retail or whether it be, kind of old tech, if you will, whether it be, cable systems or cable networks, parts of commercial real estate. I think what we kind of said is that part of the market, it's really hard to make money there. That is a pond with not a lot of fish in it. And I'm going to spend my time kind of ignoring that. So if you look at CAP from a portfolio composition perspective, you look at it today and say, the biggest bets we have in the portfolio are kind of GARFI stocks relative to the market. And the biggest underweight would be kind of secularly challenged companies that are not accreting value over time, where time is not your friend. And we try to avoid those stocks. It's not just avoiding them that creates alpha. It's the ability to take all that time and resources that I have at my disposal and focus on the 100 companies that are the most likely, what we call kind of the core cap stocks, that are the most likely to create value for our clients on a long-term basis. We spend a lot of time with this concept of ROTS, return on time spent. And again, if you don't have to worry about that 25% of the market, you spend all your time with those 100 companies that really matter to your portfolio, the odds of success within those 100 companies is even higher over time.
Most active stock funds don't keep up with their benchmarks after fees. Some ascribe that to benchmark hugging. Do you think that's the case, or are there other factors at play?
Well, I think there's a couple of factors. I think benchmark hugging is clearly one thing. And, I think about this industry, and this is an industry that tends to, even if you're average, you can still make an incredible living being average in this industry relative to school teachers or a doctor, a number of other professions, right? This is a very high paying profession that we're in. And so I think a lot of people look at it and they say, I want to take a little bit of bet, but I don't take a lot of bet. If I don't take a lot of bet, I can never get fired, right? And so that all encourages benchmark hugging, if you will. I think the other thing, again, I would say, and this comes from experience, is I think a lot of portfolio managers, they're not in the weeds on their companies. They let the analysts be in the weeds, and they try not to be in the weeds. And again, from my experience, I think that's a mistake. I think the last thing I would say, and it really goes back to this macro outlook, almost this tyranny of the consensus macro outlook, is I think most portfolio managers, whatever the consensus macro is, they assume that's going to play out, and they're kind of always investing in concert with whatever that macro outlook is. So, Wayne Gretzky always talked about, I want to skate toward not where the puck is, I want to skate to where the puck's going to be. And what you find is if you're always skating to where the puck is, or always investing in concert with what the macro sentiment is, you're buying financials in Q1 or Q2 of 2018. You're buying defensive stocks in March of this year, right? You're buying defense stocks in Q4, December of 2018. Being able to be a contrarian on that also, I think it really destroys a lot of value. So I think all of those things kind of come into play, but I think it's a culmination of all of those things.
You mentioned some of the aspects and dynamics of working with analysts. What's a recent example of an analyst turning you around on an idea? For instance, a purchase you wouldn't have made or a sale you'd have made but for an analyst's argument otherwise, and how representative is that of how your process tends to work?
Okay. And I'm going to go back in time a little bit, because I don't want to speak anything that we haven't publicly disclosed. But we interact with the analysts. We spend a lot of time, especially those analysts that cover those CAF 100 stocks that are kind of the core of what we do. We spend a lot of time with those analysts. Without mentioning an example, I'll give you a more recent example, but I won't tell you the name. We had a view on a certain company in the healthcare arena that it was kind of a recovery play that we thought had a lot of upside. And I think we bought it very well in the downturn. And I think our analysts came back and said, look, the growth expectations the market has for this company are just too high. And their competitors are getting stronger. So the multiple you're using is too high, and the growth rate you're using is too high. And that led us to reduce that position size. And that's a great example of working collaboratively with the analysts. But I think there's a lot more situations where we're sitting down with the analysts, we're talking about their areas, we're talking about what's underperformed, what's disliked, what is underappreciated. And we come out of those meetings and we're actually buying a name. In many ways, we'll sit down with an analyst, spend an hour with them, we'll focus on the name. They'll say, this is underpriced, it looks attractive, it fits with your strategy. Then we'll spend the next week doing deep dives in the company, looking at valuation, doing calls with experts, understanding the 3 or 4 things that are the most important around that company. We'll build a model. We'll build a model out to 5 years. We'll project an expected 5-year return. And again, that's more of how it tends to work, if you will.
In what aspect of your approach do you feel you differ the most from your fellow portfolio managers at T. Rowe? Was this always the case, and how have you gotten comfortable with those differences? And then maybe on the flip side, what's something you've learned from your peers that's now a bigger part of your process than was true at the outset of your career?
Well, let me answer the second question first, actually. It's been my privilege, and again, it's been my privilege over my career to really learn from some of the best portfolio managers, whether it be a gentleman, Bob Smith, who used to run the growth stock strategy, whether it be Brian Bergheis, who continues to run the mid-cap growth strategy, Jack Laporte, the late Jack Laporte, who ran our New Horizon strategy, or even Henry Ellenbogen, who ran the New Horizon strategy, who's actually not at T. Rowe anymore. But I think, what kind of defines all those portfolio managers and what really led them to generate the amazing alpha that they generated was, I would say, a couple of things. It's a little bit longer term horizon than that of the market. I think we've tried to become a little more long-term in our outlook over time. Also, again, if you look at all those guys relative to their benchmark, they tended to be a little bit more GARPy, kind of the term that someone uses, plotters. They just plot along, they kind of, accrete value in these low teens and maybe get a little bit multiple, maybe mid-teens kind of value, and they're lower risk. And so I think, watching the magic, what Brian Bergheis has done, what Jack Laporte did, what Bob Smith did, again, in a little bit different asset classes, has been really instrumental in terms of how we invest and how our strategy has evolved over time, I would say. I would also say, I mentioned this earlier, working with Ferris Shugi on the quantitative side, understanding the factors, understanding I have these objectives. These objectives are very, very difficult to achieve. What is the best way to do that from a factor exposure, a sector exposure? So someone like Ferris Shugi has been a very instrumental part of our success over the last decade or more. And T-REIT has a tremendous number of strategies that have created a lot of value for clients over a long period of time. So I don't want to be critical of anybody relative to myself. I mean, what I would say is we have chosen to have a more concentrated strategy than other portfolio managers. I personally believe that you don't need to have a 100-stock portfolio to get diversification. I think one of the things we've always found is, your best 40 ideas are really good, but then when you start going, the 40 through 50, 50 through 60, 70 through 80, the quality of those ideas tend to go downhill a little bit. So we've chosen to have a more concentrated strategy relative to a lot of other strategies here. There are other strategies at T. Rowe that are concentrated in nature, but I think we have one of the more concentrated strategies at T. Rowe. And again, it goes back to those objectives. The only way I can achieve all those objectives is we really need to outperform the equity market by 300 basis points a year. And we've done that. I mean, we've done that more than, I think last year was 700 basis points outperformance. The last 14, 15 years has been 400 basis points of outperformance. But you can't outperform by 400 basis points a year or 300 basis points per year, if you have 100 stocks, right? It's just very, very hard to do that. You really need to be a little more concentrated. So again, we have amazing portfolio managers here at T. Rowe Price. We have amazing fundamental research at T. Rowe Price. So we've just chosen to be a little more concentrated than my fellow portfolio managers.
We did have a couple more questions for you. I did want to ask about a specific stock, General Electric, which is one of the fund's top holdings. It looks like you've owned it since late 2017 or so. The stock has fared poorly as the company deals with operational and legal setbacks of various kinds. I'm sure valuation colors your thesis, but when you see a firm where management hasn't executed or the strategy hasn't worked, how does that inform your approach to that name?
Oh, sure. Let me say a couple of things on GE. One I say is we did start a small position in 2017 when there was an activist involved, but then we actually quickly exited it as we did more work on the name. So we really started a position when Larry Culp was named CEO in the end of 18. So, I know it's kind of crazy, but if we own about $2 billion today of GE stock, my cost basis on GE is $6.30 today. So, it's actually been a pretty big value creator. If you think of the stock at $11.40, our cost basis on that last $2 billion of stock is $6.30. So our timing has been pretty good on GE, I would say. But there was a period of time for 10 years we basically ignored GE, just like we ignored the secularly challenged companies, for one simple reason. GE's history on capital allocation was so poor. I mean, the last decade of GE, it's actually kind of sad in terms of how poor that company deployed capital, whether it be on whether it be all the oil and gas acquisitions they made. It's just really, really poor. And they ran the company for earnings, not cash. And for all those reasons, we basically ignored GE for almost a decade, right? And it was a big source of alpha generator. But what changed, obviously, is when you had Larry Culp, who, Larry Culp ran Danaher. I was an analyst covering Danaher. I owned Danaher in the portfolio for a long time, created a lot of value. This is a classic fixer-upper, if you will. And I think we did tremendous amount of due diligence when we bought GE with the view that we had a 5-year view. We always invest with a 5-year view. We don't invest to try to maximize performance tomorrow, next month, next year. But when we were buying GE, especially we were buying GE hands over fist in March or parts of this year, when it was $6 or less, we had a view that the stock could be worth high teens or low 20s with kind of conservative assumptions on that 5-year view. And that was so far superior to everything else. I think at the time, the 5-year IRR was in the 30s. So obviously, as the stock has rebounded a little bit, we own a little bit less than we did back then. But at the same time, we still think GE has a stock that can be an $18, $19, $20 stock as we look out to 2024 without any kind of heroic assumptions. And again, I think the world post-COVID will return to more normal. People want to travel. People maybe want to travel a lot. And that'll be a really big beneficiary of them. But they're doing all the right things from cash management. So all those bad practices that kept us at G for 10 years, they're gone. Cash flow is more important than earnings, not the other way around. Capital allocation is focused on the right things, paying down debt, reducing liabilities. They've divested the right things. They're investing in the right things. I feel really confident about G on a longer-term horizon.
For our last question, I wanted to ask about overconfidence. You have been able to sustain a very high level of investment performance throughout your tenure at the helm of T. Rowe Price Capital Appreciation. We've found that managers can stumble for a lot of reasons, but overconfidence probably ranks near the top. Can you talk about steps that you've taken in addition to closing the fund to new investors to mitigate the risk of overconfidence creeping in?
Well, what I would say is from an overconfidence question is, I am very hard on myself. I'm always very, very hard on myself. So I never feel, in many respects, you never feel good. You never really should feel good, right? Investing. You want to always aim to get better. So I think one of the things that we've done over time, is we try to get better every year. Not better because, a stock went down, that was bad. The stock went up, that was good. But from a process standpoint. So every year we try to learn from our process to get better and better and better. We try to find more market inefficiencies we can exploit. And so it doesn't guarantee we're always going to, outperform the market. It doesn't always guarantee we're going to outdo what we've done. But I think the fact that we have a process in place that continues to get better every year, we have a great team, a great platform. I think it reduces that risk of overconfidence. Because again, I speak for myself here, but you never sit back and look back and rest on your laurels, right? It's always, I want to do better tomorrow. It's funny, I'm lucky enough to win a couple of awards from Morningstar, but I don't actually have those out in my house. They're in a closet somewhere because I don't want to be reminded of my past success. I want to be focused on delivering better value tomorrow than I did last year. And so if you're hard on yourself, you want to get better every year, you have a good process, you don't rest on your laurels. I am spending just as much time, if not more, on the micro aspects of my companies than I was 2 or 3 years ago, regardless of how good the track record has been. So we're not letting up. Again, doesn't guarantee we're going to continue to do well. Doesn't mean that all our GARP stocks or utilities are going to do well every year, every month. But having a really good process in place increases the odds of success over the next 5 years. And that's really what we're focused on.
Well, David, this has been a fascinating discussion. Thanks so much for taking the time to share your insights with us. We really enjoyed it.
That was really good questions. I've enjoyed it as well.
Thanks so much, David.
Thank you.
Thanks for joining us in The Long View. If you liked what you heard, please subscribe to and rate The Long View from Morningstar on iTunes, Google Play, Spotify, or wherever you get your podcasts. You can follow us on Twitter at SYouth1, which is SYOUTH and the number 1.
And at Christine_Benz.
George Cassidy is our engineer for the podcast, and Carrie Gretchik produces the show notes each week. Finally, we'd love to get your feedback. If you have a comment or a guest idea, please email us at thelongview@morningstar.com. Until next time, thanks for joining us.
This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. Jeff Patak is an employee of Morningstar Research Services, LLC. Morningstar Research Services is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analyses, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk. including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.